There are a ton of great ways to make money in real estate investing, but let's be honest, most people who are interested in real estate investing are interested because they want that passive cash flow. That's probably why a lot of you are watching this video in the first place. The problem is that over the last couple of years, cash flow has been increasingly hard to find. But luckily, that does not mean that cash flow is impossible. And in fact, in today's video, I'm going to share with you the background as to why cash flow is getting harder to find. But I'm also going to share with you my top 10 best markets for finding cash flow in 2022. And I also have a download for you. It's completely free where you can get data about the top 100 largest markets in the US and the cash flowing prospects for each and every one of them. So you're definitely going to want to stick around for this one if you're interested in financial freedom and generating cash flow through real estate investing. What's going on, everyone? My name is Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets, and I'm also the host of BiggerPockets' newest podcast called On the Market. On that show, we cover topics just like this. We talk about the data, the news, and the trends that impact real estate investors in order to give you an advantage in your own personal investing. So if you like content like this video and these types of topics, make sure to check out and subscribe to the On the Market YouTube channel. You can find a link in the description below. With that, let's talk about today's topic, which is where to find great cash flow in 2022. People have been saying for a long time that cash flow is getting harder and harder to find. I noticed this in my own investing, right? When I go out and look for houses, there are fewer and fewer deals that pencil and offer the type of cash on cash return that I'm generally looking for. But being the data guy that I am, I wanted to understand this on a deeper level and not just take this anecdotal evidence. And so I did an analysis, and it shows that cash flow has in fact been falling on a national level since 2012. And I did this by looking at some metric known as rent to price ratio. This is a very simple calculation that compares the rent that you generate from a property to the purchase price, and it's really helpful in estimating cash flow. It definitely doesn't give you a precise number. I wouldn't recommend anyone make investing decisions based off rent to price ratio alone, but RTP is a great way to just look at broad trends. And when I look at trends, as you can see in this graph, that rent to price ratio was at its highest point it's been in the last decade back in 2012, and it has been falling ever since. This sort of backs up what a lot of people think about cash flow. It is in fact getting harder to find. Now, does that mean that this is weird and cash flow is disappearing? I don't think so, because I actually think what was going on in 2010, 2011, and 2012 was an anomaly. That was actually an abnormally good time for cash flow based on what happened during the financial crisis and the subsequent fallout. What happens in recessions, and particularly in the Great Recession, is that home prices can and tend to fall more than rent. So when you look at the average growth rate from 2008 to 2012, home values fell on average 5% on a compounded basis, but rent was down less than 1% on a compounded basis. So this means that rent to price ratios went up a lot around the Great Recession and then have mostly just been coming back to normal. So yes, cash flow over the last 10 years, it's getting harder and harder to find, but it is more a reversion back to normal times than it is a crisis or something changing fundamentally in the way the housing market and rental markets work in the United States. So I just want to validate people's beliefs and observations that cash flow is getting harder to find. But that is on a national basis. And if you watch my podcast or other YouTube shows, you know that I like to say, I borrow this from Kathy Fettke, that there is no national housing market, right? I use these data because it helps explains broad trends, but every individual housing market is going to be different. And there are some housing markets in the United States that still offer excellent cash flow. So I did an analysis and I picked my top 10 favorite markets for generating cash flow right now, today in 2022. So with no further ado, let's start going through our list. At number 10, we have Milwaukee, Wisconsin, which has a rent to price ratio of 0.7. Now, I should mention that a lot of people out there are probably familiar with the 1% rule. The 1% rule states that if you are going to invest in a rental property, it has to have a rent to price ratio of more than 1%. And now here I am stating that Milwaukee, Wisconsin is a good market for cash flow with a rent to price ratio of only 0.7. So let me refute or explain at least why I don't subscribe to the idea of the 1% rule really quickly. Number one, it came about, the 1% rule was a useful rule of thumb back in like 2010. And as I just explained, that was an anomaly for good cash flow. And it's no longer really an applicable rule of thumb. And if you follow it really strictly, you're probably going to be missing out on deals that are really good by today's standards if you're really obsessed with that metric. The second thing is that rent to price ratio is just a proxy for cash flow. It is not actually your cash on cash return. It is just a way of estimating what your cash flow might be. So you don't want to get too obsessed with this, and you want to run your numbers on every individual deal to figure out that cash on cash return. That's the number that actually matters. And lastly, and most importantly for this conversation, when I'm talking about broad market level data, rent to price ratio is just an average, right? So the average in Milwaukee, as I just said, was 0.7%. And yes, that is below 1%, but because it's an average, by rule, that means that there are going to be deals that are better than 0.7%, and there are also going to be deals that are worse than 0.7%. So as an investor, it is your job to go out and find the deals in this market that are above average. So if you're in Milwaukee and a deal is 0.7%, you absolutely can go find a deal right now that meets the 1% rule if you subscribe to that theory. So just keep that in mind. These are averages, and I'm just trying to present markets that have the potential for good cash flow, and Milwaukee is definitely one of them. Another thing I like about Milwaukee while we're on the topic is that it has a relatively low price point. The median sale price in Milwaukee is still under $200,000, which is about half what the average is for the rest of the country. Coming in at number 9 is Philadelphia, Pennsylvania, which has a median sale price of $234,000 and has a rent to price ratio of 0.77%. So significantly better than Milwaukee, but a little bit more expensive. 8th on our list is Indianapolis, which has been sort of a darling for cash flow for the last couple of years. And let me just tell you some stats about why. It has a rent to price ratio of 0.83% and a median home price of only $159,000. So this is a super cheap market to get into, and you are seeing double-digit home appreciation and double-digit rent growth over the last couple of years. Now, looking at rent growth and home appreciation over the last couple of years is a little deceiving because the market is shifting and it is definitely starting to cool down, but it is notable that Indianapolis had really strong growth. 7th on our list is another cash flow darling, which is Memphis, Tennessee, which has a rent to price ratio of 0.84. So we're getting closer and closer to that 1% rule, and had 23% year over year appreciation last year, which is incredible. The median home price is just $163,000. So relatively a really affordable market. And the median rent is almost $1,400 a month. So that to me screams cash flow potential. 6th on our list is Akron, Ohio. This is the first time I've really looked into Akron, but super attractive market with the median sale price at $113K and year over year home price appreciation at 28%. Rent went up 16.5% last year, and that comes in at a rent to price ratio of 0.87%. Next is Macon, Georgia, with a 0.9 rent to price ratio, 21% appreciation, and rent growth of 14%. Coming in number 4 is Orland Park, Illinois. I have to admit to you guys, I don't even know where this is. It is the most expensive market on this list with home prices at $290,000, but it has a rent to price ratio of 0.92% and rent grew 18%, the fastest of any market on this list last year in Orland Park, Illinois. Coming in third, we are now on the podium. So getting the bronze medal is Cleveland, Ohio, with a rent to price ratio of 0.98. So almost meeting the 1% rule on average, but it has a median sale price of just $130K, which is relatively cheap and has pretty strong rent growth at 11%. One of the lower appreciation markets for sure at 9%. I mean, in a normal year, 9% appreciation would be really incredible. But given what we're seeing in the other markets where, Memphis had 23%, Akron had 28%, 9% in Cleveland is relatively low. Number 2 for cash flow potential is Shreveport, Louisiana. This is a really interesting market. It is relatively inexpensive. The median home price is less than $100,000. It's $93,000. And the rent to price ratio is above 1%. So on average, you can get a 1% rule deal in Shreveport, but the other metrics aren't so great. So the year over year price appreciation actually went down 5% in a year where housing markets across the country really went up. So this is an anomaly and it's not something I would take lightly. The point of this video is to tell you where you can get cash flow right now, and certain investors, you might be one of them, really just look for cash flow and don't care about appreciation as much. Personally, I would not invest in a place like Shreveport because it has negative 5% appreciation, and that worries me. Rent growth in Shreveport was only 3% last year, whereas the second lowest was 7.5% in Milwaukee. So it's performing way worse in growth, but just in terms of pure cash flow numbers, Shreveport is number 2 on our list. Now, for the gold medal winner of cash flow in a complete league of its own is Detroit, Michigan. And Detroit has been at the top of this list for years, so this isn't surprising. But guess what the rent to price ratio is? Like, we're talking about places not meeting the 1% rule. In Detroit, it meets the 2% rule. It is a 2.22% rent to price ratio, and the median home price is just $63,000. Now, I've read some stuff about Detroit that is really promising, that there's really encouraging economic revitalization, and that might be reflected in the fact that it saw 29% year over year home price appreciation. That is the fastest of any place on our list, and it had rent growth of about 7.7%, not really close to the top of anywhere on our list, but still really encouraging. So that is my list of the top 10 markets. If you want to learn more, you can actually visit a link below. I'll put it below, where there is a download to a data set that shows this data for the top 100 cities in the United States. And you can download that on BiggerPockets completely for free. So go enjoy that. If you didn't hear about your city in these top 10, you're curious about the cash flow prospects of your city, just go download this data. It's 100% free. That's what I got for you all today. Hopefully this is super helpful to you in your pursuit of cash flow and financial freedom. If you like this video, we really do appreciate it if you subscribe to the On the Market YouTube channel and give this video a thumbs up. If you have any feedback for me, you want to interact with me, you can do so on Instagram, where I am at The Data Deli. Thank you so much for watching, and I'll see you all next time.